November edition of our event. And this time we have an amazing talk. Um, One of the two best world journalists on the stage together, Alex Wilhelm from TechCrunch and Steve here, who is now ex-TechCrunch and VP of Strategy for Zapp. And I'm really looking forward to this talk tonight because we will hear so many interesting stories. But not to brag too much about it, I'll let speakers come in and join. But I would just like to mention that this event wouldn't be possible without our partners, Lewis Silking, who's a legal firm in London. So please check out their website. They have like a brand new spin-out for Cube. So it's cube.lewissilkin.com, where you'll find all the legal things about startups through all the stages. And now, without any further ado, I would like to invite to our virtual stage Alex and Steve here. Hello, guys. Good evening, good morning, good afternoon. We are tuning in from all sides of the planet, I guess. Alex, you're muted.
It's 2021, ladies and gentlemen, and I'm still getting that wrong. I just want to point out that I'm at home on the East Coast of the United States. Steve, you're at home, and Peter is in Costa Rica. So no one told me this was going to be like the vacation episode. I would have gone somewhere warmer.
Yeah. Okay, guys. I'm really looking forward to this talk. Please, the stage is yours.
All right. Thank you. Just getting a little bit of an update. There we go. So Steve, hi. It has been a couple of weeks since I talked to you last. For people who don't know, though, tell me a little bit about when you joined TechCrunch and when you left. That might be the best place to start, I
think. So I think I joined in 2009. Then I left for a short while because I went and did my own startup, right? So I kind of got the startup bug, went and co-founded a startup, and I came back, I think, like 18 months later, stayed for 8.5 years, and left. Don't laugh, that's not funny. I was only going to be there for a couple of years, right? 8.5 years later, and then I joined Zapp in April this year. Oh my God, 6 months, I think, already.
Yeah, I remember when you came back to TC because I joined for the first time in 2013, I think it was. And on my very first day, I still remember this, you stayed late at work to help me finish the first thing that I ever had on the site. And I was like, this Steve guy, he's great. And then we worked together for a couple of years. I left TechCrunch for a while and came back, and you were there, and now you're leaving. And so I'm presuming that I'll stay for 2 more years and you'll come back in 2 years and we'll kind of cross paths again. It's the very TechCrunch way of going about employment. But 8.5 years, man, that's a long time to be on one side of the fence, you know, on the journalism side, not on the operational side. So I'm curious, what are some top impressions or things you've learned in the last 6 months, say, being on the other side of the fence?
Yeah, so I mean, it's been obviously, I mean, as a journalist, as you know, you're on the outside and you're trying to get the inside. Right. So, you know, and I always thought, I always thought of myself as kind of the outsider with inside access as a journalist, because obviously over all those years, I built up some amazing sources. But that said, it isn't, you know, it is 100% different being inside and seeing how a company is built from, you know, from the ground up. And I think what's been kind of extraordinary about joining Zapp in particular is that because the space we're in, which is the on-demand convenience delivery space, so delivering snacks, drinks, essential groceries and other household items within 20 minutes or within minutes, 24/7, that's our proposition. That's like a mixture of logistics and technology, right? So that means investing in our own local fulfillment centers, distribution center, our own fleet of riders. So that's a huge amount of headcount and quite a lot of complexity. And then we've grown, you know, so quickly. I think we're well over 1,500 employees, about a year old, right?
Yeah.
And so even though I'd seen a lot over 8.5 10 years, 15 years as a journalist, whichever way you want to slice it, joining a company that in this particular space, growing this fast with this kind of headcount and complexity has been, just a revelation.
Yeah, that's what I wanted to hit on, because I'm curious if now that you're back on the kind of operational side, you have a little bit more, not patience per se, but almost like sympathy with other people who are building stuff, because it's easy to sit on the journalist side and, I would say politely throw stones, but now you're, kind of shoulder into it, trying to make things work. So has it changed your perspective on kind of what you did when you were a journalist?
So I think it would be easy to say yes, because I think normally that argument would be true, right? As a journalist, there's a certain amount of kind of, you're the commentator. Like it's like when you watch a football match, right? We're all fans. We can all be like, hey, that manager sucks, or those tactics are terrible. But I was lucky enough to go and co-found a startup and raise a round of venture capital. So in that sense, the first time I left TechCrunch, I think there was a bigger learning of like, oh my, like that's what it's like. Like as a founder, that's the kind of challenges, and they're the sort of the nuances that you maybe miss as a journalist. So when I came back to TechCrunch, I think I'd already had some of that sheen taken off, right? So I came back maybe a little bit more cynical, but also a lot more empathetic. So it's that kind of dichotomy of
Yes.
kind of questioning, interrogating, but also having incredible empathy for founders and also operators, right? And to a lesser extent, VCs.
We're not going to talk about VCs a lot, but I would recommend against empathy for VCs. I'm all for empathy for founders, but I struggle to ever really engender quite a lot of emotional support for the investing classes. And also, Steve, as a data point, I think what you're saying is dead on, because I was working at a startup that was covered by TechCrunch when I was, when it was like 3 people. And so I remember like the TechCrunch impact, for lack of a better phrase, of what that was like as an employee. And I've also been at startups since then. So I think, empathy is the right word. It's much scarier to be trying to change the world than it is to be a person saying that you're not doing a good job at changing the world. It's wildly different in my experience.
Yeah, no, absolutely. I think the empathy comes from just, when you're a founder or you're in a startup, you're trying to do really difficult things, right? And I think when you're operating like on a huge problem, like the certain problem space you're working on, then from that comes a lot of nuance, right? And I think a lot of journalism misses the nuance. So journalism is great at saying, this is amazing or this sucks, but isn't always as good at saying, actually, there's a whole bunch of trade-offs, right? There's a whole bunch of things that they're kind of judgment calls. And I think and so when you go on the inside, you're seeing those trade-offs, those judgment calls, that balance around short-term survival versus long-term thinking and long-term investing, and the whole swathe of decisions that come along the way, hopefully trying to tip, the balance in your favor to be successful as a founder, as an operational team, as a company as a whole, right? And I think that is what journalism doesn't always do such a good job capturing, not because journalists are terrible, but because it takes time and investment, and maybe those stories are, nuanced and interesting, but not necessarily interesting to enough people to be worth investing in.
Yeah, I was about to say, if you write a story entitled, the nuance behind the decision that led to the product change that some people didn't like, 7 people might read that. But if you say Elon Musk did dumb tweet, 64 billion people will click on that tweet instantly to go see what the hell's going on. So there's always that balance. But slowly leaving the journalism circle, I was prepping for our talk today, and I'd forgotten until I saw it on the site that you had actually covered Zapp back when they raised their $100 million round. So you were actually reporting on the company. And I'm curious, was it during that process of breaking that bit of news that you kind of became perhaps enamored with the company and wanted to possibly go join?
So, I mean, yes, but that's the short version. So I'll give you a slightly longer version, which is probably a bit more interesting. So historically, I'd kind of accidentally gone very deep on the original kind of takeout delivery space, right? So in the UK, that's like Deliveroo, and then there were like tons of competitors. Just Eat before that.
Yep.
Obviously Uber Eats. So I'd gone quite deep on that space. And I remember one day I remember phoning up on the same day, like all 6 of the main founders of those companies, including, I think, Deliveroo, Will Shoot. So then I think maybe you did a bit of this, but I jumped onto the e-scooter market, and I could see similarities and parallels between that market and takeout. And then when I saw quick commerce
Yeah.
or rapid delivery, whatever you want to call it, the model intrigued me like immediately, because these were companies that were not building kind of asset-light marketplaces,
Yes.
but in some ways were a little bit more like the scooters, having to invest in infrastructure, but actually I would argue invest in like real infrastructure. So that's stores, warehouses, employed riders, so no gig economy model, but in UK, Europe, it's the riders are employed direct. So this kind of iteration of some similar concepts in a way that I found like positive, kind of ethically, and also to me it made a lot of business sense. So I gravitated immediately towards the space, covered a ton of competitors, and then in that, obviously I heard about Zapp, right? And I'd known the founder for more than 5 years because I covered his early startup, like right in the early days. As you know, as you remember, Alex, I was always interested in covering companies super early, right? So ones that you would never heard of necessarily, but I had. So so I remember calling up. I was trying to get the scoop. I knew that Zapp existed. I knew it was maybe a little bit different, being more kind of convenience retail and less about fresh groceries. And I thought that kind of made sense to me. And so I was trying to get this funding story over the line. And then as I got it over the line, I mentioned to the founder, and I haven't really told this story that much, but I mentioned that I was thinking about leaving TechCrunch.
Yeah.
Because in all honesty, I'd already decided that I maybe it was time to leave, and I'd had actually another really good offer. And the founder of Zapp said, "Hey, why don't you come and join our team?" And I went, "Well, what would I do?"
I can write, I can tell jokes, and I'm good on stage. What does that translate to?
Exactly. And then and then we had a really honest discussion where, you know, I said, look, I don't want to do straight comms. I want to be a bit more involved in other areas of the business, and so we figured out a kind of role that would suit me. And I think I have written about this. I also said, look, I've got certain things I have to manage relating to my disability. So, you know, I need to work predominantly, if not completely, from home. I need to be in charge of my own schedule so I can kind of balance the careful balancing act that requires. And I think the CEO founder, Navid, just said that, you know, if we can't employ someone like you at Zapp, I don't want to start a company. And I was like, okay, I'm in.
Well, I mean, the flip side is, having worked with you, I know exactly how much of a workhorse you are. Like, it's not like making some accommodations is going to limit your output. You've been prodigiously productive every minute that I've worked with you. So I can see why they'd be willing to make the changes. Because not to be overly polite to someone that I'm interviewing, but I've just known you for so long, I can just say this: you get a lot of shit done. So
yeah, and I mean that's like how it's interesting, because that's how I've always approached my career, which is like, judge me on the results, not how I get the results, right? And I think even my journalism was somewhat like unorthodox in the way I would source and build a network almost entirely online. But I think there's a weird one here, which is that, you know, startups and tech, you know this, Alex, you know, especially in Silicon Valley, they sort of laud themselves on meritocracy, right? And this creates an incredible blind spot where oftentimes they're anything but meritocratic. So I've always argued that, you know, at the end of the day, disability or other kinds of biases, or, you know, it's all about setting up employees for success. So that's what I've really enjoyed about Zapp, is I've joined, the CEO founder has stayed true to his promise. The company has been amazing in the way, you know, because the company was founded in the pandemic. So in a sense, everybody was remote, right? And now we're hybrid, but that's created a greater sort of level playing field where remote, hybrid, office, it's all seems to be working out really well. And I've taken that kind of, that learning, that when I'm hiring, when I'm supporting colleagues, especially people that are lower down in the org chart,
yes,
the
definitely.
first question I asked is, and this is to anyone, not people with disabilities, like what do we need to do to set you up for success? Because if you set your employees up for success, I think it's a very smart thing to do, and hopefully will tip the balance in favor of the company being a success.
Well, it does, because it limits retention and allows for you to keep more intellectual capital state. I mean, people just do better work. I mean, you and I have both been remote first people for a long time, so the pandemic was actually kind of funny because suddenly the world came to us versus us being kind of the outliers, and everyone realized that you can type on a keyboard anywhere, really. I mean, we were joking earlier about Costa Rica, but Peter is literally somewhere else. Like, we're on 3 different bits of land. You know what I mean? Like, it's fine. It's a perfectly reasonable thing. But
yeah, for sure.
Steve, I want to pause really quick. I forgot to say this up front. Everyone, Q&A. If you have a question for Steve, feel free to throw it in the chat. I have that pulled up, so I will be occasionally looking over at it, but I will be keeping tabs on that. I have a zillion questions about Zapp. We're about to get into that, but if there's something that you want to ask, feel free to throw it in, and if it's good, we'll ask it, and you'll get a response from Steve live. So feel free to be interactive. Sorry, Steve, back to you.
No, I was just going to say, you said about like, I have worked remote for years.
Yeah.
Of course, when you're a journalist, you are only as good as the stories you break, you publish. So there's nowhere to hide, right? So
Yeah.
we're used to, having an incredible amount of trust, but also a very direct line of accountability.
Yes.
And I think what the pandemic has taught many, many leaders is that actually, most employees want to work hard. They want to get stuff done, and that can happen from home, from places other than the office. Although I do think a hybrid is probably the way forward, which is basically saying, not everybody works the same, right? It's not about a one size fits all. And I think that's what we're adopting at Zapp.
So let's talk about Zapp. So I was familiar with Zapp. I'm familiar with a number of the players in your local. Let's pick one. Quick commerce, rapid delivery. What do you prefer?
Rapid delivery, but or Zapp on demand convenience.
Well, that's a variety of it. Let's just call it rapid delivery.
Sure.
The rapid delivery market is relatively crowded where you are. A couple of names. There's at least there were when I was prepping this. Jiffy, Dija, Wheezy, Gitter, Gorillas, Zapp, and I think there's also a couple of smaller players as well. What has led to the enormous proliferation of these businesses in the UK market lately? And I know you're in Europe as well. We'll get to that in a second, but specifically kind of local to you, why is it so popular?
I mean, I think there's various reasons. I think, the UK has always been a very early adopter of e-commerce, right?
Yeah, true.
E-commerce in the UK is huge. I think anything online in groceries, including convenience grocery, which is a subsector of grocery, is, essentially is in part an e-commerce play, right? It's the digitization of what we normally did offline has moved online. And I think we saw that happening at a certain pace prior to the pandemic. And then, of course, the pandemic struck. And even though we've had online grocery in the UK for many, many years, like big, huge supermarkets, they were very much about planned ahead, like book a delivery slot,
right?
3, 4 a week in advance, pick your shopping list, hope that on the day of delivery, when they pick the goods off the shelves, that actually what you wanted was in stock, and then that would get delivered, and you would deal with sort of automatic replacement items where you want one thing and they decide, well, we didn't have that one thing, so we give you the second best thing, but it turned out it was the 5th best thing. So so I think then when sort of rapid delivery, which it's about what you order is going to be in stock because you're getting it delivered sort of within minutes. I think that resonated with customers in that pandemic moment, and then those habits have remained, right? And I think at Zapp, we saw that when lockdowns ended, so the last main lockdown, on the following Tuesday, like we had our biggest Tuesday ever at that point. So, and then we've seen since that people use certainly Zapp, they use it more and more post lockdowns because we're very much sort of living in the moment. So when you're socializing, when you have friends around at short notice, then that ability to order what you want when you want it, drinks and snacks, that type of thing, sort of makes a lot of sense.
Yeah, I've been thinking about this a lot from the just the American context because that's the market that I live in, order in, frankly. And Instacart, we tried Instacart, my wife and I, a couple times early pandemic, and we found the issues that you're talking about. You would order a jar of pickles, they would bring you a banana and say, "Hey, it's a vegetable," and it wasn't really what we wanted, and so we stopped doing that. But I have occasionally used GoPuff, kind of a Zapp cognate or comp, if you will, in the U.S. market, a couple times here and there because I needed like one day I had a horrible headache and I had a bunch of work to do. So I literally just like had them bring me aspirin and that was amazing. But it's not cheap. And this is a question that I wanted to get onto because Zapp has such a consumer friendly model. I was on the site. It's a £1.99, or if you spend more than 30 quid, it's free delivery. Gig workers get paid. It seems to have strong, like positive vibes everywhere. But I'm curious about how the overall economics shake out because in the US, Uber Eats has been notoriously unprofitable, et cetera. So why does the math work for Zapp when everything seems to be so kind of consumer and worker friendly?
Okay, yeah. So you said gig economies get paid. Gig economy workers get paid. They're not even gig economy workers. Right, at Zapp, our riders and our store workers are directly employed by us and full members of the team. And in fact, just like any employee at Zapp, they have the opportunity to earn stock options.
Yeah.
Right. So just to correct that. So yeah. So I think the reason why the model can work, and certainly the version that we picked, which is that focus on convenience items, so things that you need and want instantly that make sense in that use case, whether that be last minute socializing, things that, like you said, you mentioned over the counter medicine,
Sure.
things where the urgent need trumps necessarily price sensitivity. Like within that model of convenience, it can definitely work. And what you need to make it work are three things. So you need average order value, which is like the average basket size. So at some point, you need the basket size to be big enough to absorb most, if not all, of the delivery costs. So that's one. Second thing you need is that you're selling the right kind of products that have the gross margins that allow you to make ultimately a profit, right? So that's selling products where there's enough margin to help again make the model work. And the third thing, which is probably the most important and the bit that kind of excites me the most, is you need to build that infrastructure to then get economies of scale, right? And eke out as much efficiency right across your own supply chain. So what do I mean by that? I mean anything from a kind of rider utilization. So the riders that are on shift, are they doing enough orders per hour to make sense, right? And are you pushing those orders through in the right way? But it also goes right back to earlier parts of the supply chain, which is, the per store efficiency.
Mm-hmm.
Are you replenishing your stores quickly enough so that when someone wants something, you have it in stock, right? And on that note, we've just recently invested in a London distribution center. So we have like a massive DC, which means that when we stock Zapp, we can buy more centrally, put the stock into our DC, and then using data and predictions, work out, hey, that store in West London is going to run out of Haagen-Dazs. Like, let's get some inter-day replenishment to that store, rather than relying on the wholesaler
Right.
to do a round trip to each individual store. So yeah, I hope that makes sense. So it's an infrastructure play.
Yeah.
And in fact, we talk about our long-term mission as being, building an entirely new supply chain that's able to get you what you want when you want it, potentially to millions of customers in various parts of the world, all within minutes. So do that more efficiently, faster, and more sustainable than any supply chain that exists today. And that is really a 10, 20-year journey. And that's what people don't see. They don't see that behind their bag of potato chips or their favorite bottle of wine arriving in minutes.
I believe you call them crisps. Am I wrong about that? I think we call them chips.
I was trying to be international, Alex.
Okay. So you use American slang and I'll use UK slang, and it'll be good. So I understand the overall theory behind the model, which is larger baskets, goods with high margins, and I would throw in frequency of use from individual customers, lowering effective CAC. But with so much capital going into the rapid delivery space and with so many competitors, is it difficult to charge enough for goods in comparison to other providers that might be willing to take a loss to grow as quickly as you want and have the economic profile remain healthy?
So I mean, that's the classic VC game, right?
Yeah.
So in a sense, are you competing on the immediate viability of the model, or are you just throwing capital at the problem in the hope that you'll figure it out later? I think it's sort of kind of more practical way of saying it. So I think at Zapp, again, it comes down to the fact that we're not competing in the sort of, hey, don't go and do plan ahead grocery, shop as often as you like, smallest basket size as you like, kind of proposition, versus being very specific that we're a convenience retail play, which does have the products with the higher margins, does start to creep up the average order value. So we're seeing that our average order value is like mid £20 versus competitors that are much lower than that, and versus traditional convenience in terms of the supermarkets, they're kind of mini grocery stores. I've heard that being talked about as kind of £11, and we're like more than double that. So we're already seeing it's working. If you steadfastly stick to the convenience model and put the stores in the right areas of the city with the right kind of customers that are willing to pay, and we're not like particularly expensive, but we don't. It's not a race to the bottom. We don't compete on, so we don't really do discounting, right? So if you do all those things, it can be a very profitable business, and we're seeing that. And to your point about whether you can sort of throw capital at the problem and cross-subsidize or discount and then worry about it later, the problem I would argue with that is that you create, very bad cohorts.
Oh, terrible cohorts.
Yeah.
I mean, just awful.
So what do we mean by that? We mean like customers that are only using you because you're essentially giving them money for free.
Yes.
And then they're going to, service hop. And as soon as that money dries up, they're potentially going to say, hey, it was a nice to have, but it wasn't something I need. Whereas I would argue that, again, our customer acquisition, customer base cohorts, they all look really good. And what's been like so encouraging from the inside is seeing that isn't just working in one particularly affluent part of London. It's been pretty consistent across all of our expansion over the last 6 months.
So let's circle back to the store point. You keep discussing stores that are being put together. These are, I think, what they're called just dark stores, which are effectively, I mean, my gosh, Steve, I don't know, mini warehouses that are private is kind of how I think about them.
Yeah, like kind of delivery first stores, little local kind of mini warehouses that are in or close to higher population dense areas of the city, and that is what ultimately allows you to get that delivery promise of kind of within minutes, or in our case, we're within 20 minutes, but usually a lot less than that.
And I'm curious about like scale and kind of breadth of goods that you guys can tackle, because there's an efficiency line between adding more goods, which may drive up average order value, but also the more goods you have, the more you have to kind of hold on stock. So have you guys found the right balance yet regarding kind of number of SKUs that you want to have available and what consumers want, or is that still being teased out on kind of a region by region basis?
I think we're around 2,000 SKUs
2,000.
in each micro fulfillment center or dark store or Zapp store, as we call them. But I think the way to think about number of SKUs, and certainly in the convenience space, is we either go super like narrow on a product where you don't really need choice, you just need it to solve your problem in that moment. So to your point about like painkillers, right?
Yeah.
Like you don't necessarily need like 7 different choices of painkiller. You just want to have a painkiller when you've got like a terrible headache, right? Versus another product category, and I know I messed this up on your amazing podcast that you do for TechCrunch, but another category is ice cream, where we go much wider, right?
Yes.
Because when you're shopping for ice cream, then choice makes a huge difference.
Huge difference.
Can you tell I've been rebriefed? Makes like an amazing difference, right? And I think we actually stocked something like, and I got this totally wrong, didn't I, last time? We stocked like 40 different SKUs of ice cream. So to reiterate, when choice doesn't matter, we go narrow. And when choice really makes a difference, we go wide. But yeah, it's about 2,000 SKUs up to in each dark store.
I'm going to be very curious to ask you that again in 6 or 12 months. And also the breakdown in SKUs on a per country and per city basis, because it's going to be interesting to see how that all shakes out and how much tuning you have to do for adding a new, geographic footprint. But tell me about the cost of this. You guys raised 100 million earlier this year, a big chunk of money, to be clear. Or I think it was 100 million inclusive of a seed round, according to reporting by Steve O'Here over on TechCrunch.com. So how should I think about that capital? Is that capital for a couple of years? Is it expensive to build dark stores? Is it less money than that? 100 million is such a number. How does that fit into the business plan?
So obviously I'm not going to break down specifics, and we remain
if you want.
incredibly well capitalized for our plans. But I think what's probably worth noting is we've taken a slightly different strategy to a lot of the other players in the market, which is two things. We've done far, far less vouchering. So we've given away far less vouchers as a percentage of revenue than our competitors. So that more disciplined approach has meant that we've been acquiring the right customers and not having to throw money at the problem. So arguably that capital can be eked out for longer in that sense. And the second thing we've done, which I think is really interesting, is we've seen a lot of competitors open up city after city after city. So even though they may have raised varying amounts of capital, they're arguably deploying that capital across many more geographical locations and spreading themselves really thin. And I think what I've learned from being an insider is like it takes incredible focus to build out that supply chain locally and to keep that customer promise and then figure out how to do that in a scalable way. And we've been a lot more focused on fewer cities, including investing very heavily in London, including that central distribution center. So I think when you see those big headline raises, like the way to think about it is how thinly is each company spreading themselves?
Yeah.
But also more broadly, and this applies to all of us, how much genuine infrastructure are they investing in building? Okay. And I get back to my original point, which is we are really on that long-term journey to build an entirely new supply chain. So a lot of our upfront capital costs are going into long-term investments that really will pay dividends along the road.
Yeah, I'm going to be fascinated when you guys raise again to bring up some of these questions and talk again about where the money is going, because I'm presuming it's a much higher chunk to not to supply chain, but overall infra than I would think. But I want to work on a question from Marian because it fits into this pretty well. From our friend Marian. Steve, a while ago, you predicted a, quote, bloodbath for micromobility companies as many players raised a lot of funding. Do you expect a similar scenario for rapid delivery players?
So I love the premise of the question. I didn't predict a bloodbath. I quoted a VC predicting a bloodbath. But I think the question, I was always very clever like that. Never put my name to an opinion.
What's that like?
Yeah, you're not so good at that. So, look, I think my point about micromobility was that I predicted that there would be consolidation.
Yes.
Right. I remember being on a panel. I think it was a startup Grind actually event in London, a big one, and I asked all of the players on stage, like, how soon before one of the micromobility e-scooter companies gets acquired, and they were like, "Oh, it's not going to happen for years." And I think I said it will happen within a year, and it happened within 6 months.
Yeah.
We've already seen consolidation in the quick commerce or rapid delivery space already, right? So a number of players have been bought recently. So the market is already reducing. At the same time, the market's expanding because incumbents are launching their own quick delivery services, and some of the takeout platforms have started to do a lot more quick delivery of non-takeout food, right? So in a sense, we've seen consolidation in the kind of the venture capital backed rapid delivery companies already, highly predictable. I think you and I talked about this on your podcast. When there's a lot of new players at the same time and a finite amount of capital, and it's incredibly hard to execute on all that complexity and infrastructure that I talked about in product market fit. Like, it's not really anything unusual to see consolidation happen, even at the pace at which it has.
That's a polite way of saying there should be more consolidation in the next year and a half, maybe, just given that some of these companies won't be able to raise again. And if they're spending as fast as they are, they're going to have to kind of link up. It's my guess.
I think it's a polite way of saying when you have a hot market, it's not surprising that not all companies make it to the next stage. But that said, I mean, people underestimate how big the market is. Like in the UK alone, like convenience retail is not a new thing, right? It's like £45 billion in the UK alone. If you take a certain chunk of that, it's a pretty meaningful business in and of itself, right? And also my thesis, because you asked me why did I join Zapp?
Yeah.
My thesis was that when you make convenience retail even more convenient by moving it online, people are going to use it a hell of a lot more, right? So you're actually going to grow the size of the market as well. And I think, again, early signs are people love Zapp. They love the ability to order what they want when they want it online, and and they come back. In fact, customers that join us, if they stay for a little while, they tend to stay and increase the number of orders they do per week or per month, which again is kind of fits that thesis of convenience.
Yeah. And Laura Lee Bombas asked about the rapid delivery industry scaling and lockdown. I think you kind of answered that there, which is that it does, just listening to you, it does seem that there was a pandemic bump to, I would say, e-commerce in general and delivery in general. And that's something that's persisting well into the, let's call it post-lockdown period of time.
Yeah. I mean, groceries online got a massive bump from the pandemic, right? People had to scramble and find new ways to order their planned ahead groceries. And there was like a whole issue of like people were unable to book delivery slots because there wasn't enough delivery capacity, right? We had all that. But I guess what I'm saying is more subtle is that because we play within convenience retail, so that subsector of grocery, we've actually found that even though the overall offline to online shift has benefited companies like Zapp, we found that I don't want to say post-pandemic, but post-lockdowns.
Yeah, post-lockdown.
Like, people are using this even more, like more than ever, because as I say, when you're socializing, when you're living a bit more in the moment and you're more spontaneous, that's when that on-demand convenience like absolutely fits your existing consumer behaviors.
Yeah, it'll be fun to track the percentage of kind of quick delivery revenues that come from vodka and plastic cups over time. And that'll essentially just track the party scene. And so maybe that's how we should think about the reopening cadence versus travel. Or in America, we're looking at subway admissions. It's probably, tube tickets in London, but it's a good way to think about things. I'm going to get in a couple more from the audience, Steve, and then we're going to close up with one from Tio in a couple minutes. But in the Q&A section, Dragos Scanti asks, how would the game change for Zapp now that Gitter will buy Wheezy? And I just want to say that these are the most British names of all time. I love this. But with that combination coming up, any changes for Zapp or a steady state?
No, I mean, it's business as usual. We're very much focused on customers, right? And continue to build out that. I mean, you said it, you were very kind earlier. So we have an amazing consumer offering. But yeah, no, we're very much focused on customers, on continuing to build out that supply chain behind the scenes that allows us to keep that customer promise, right? And deliver on it with each and every order. So no, I don't think we pay too much attention to what's happening in the wider market. And, because I always say, like, it's super early days for all of these companies, right? It's a very new model, very new phenomenon moving offline to online, even though, as I say, convenience retail in the broadest sense has existed, for tens of years.
Yeah. Does the so again, Steve, as you know, I'm an American, and so I'm mostly living in my domestic economy, but we're seeing a relatively interesting labor market that's leading to pretty rapid wage increases. And I would just say, higher worker demands for compensation. One, is there a similar sort of pressure in the UK on the kind of cost of labor? And does that materially impact the decision by Zapp to hire its delivery people full-time as opposed to pursuing a model that's less worker friendly?
So no, not especially. I think the decision for us to go for a direct employment model for riders is kind of two things, right? one, it's just the right thing to do. Okay.
Yeah.
But secondly, our riders are full members of the team because they are the most customer facing part of the business, right? If your order goes as it should do on Zapp, then a Zapp rider is going to be the only member of our team that you interface with, right? So ultimately, they are the face of the business. And if you want to have riders that are fully engaged, are properly trained, understand the Zapp way and the customer experience we're trying to deliver, you need them on your team, right? It ain't any more complicated than that. So for us, it's the right thing to do, and it makes sense for delivering for our customers.
I'm just curious about, say, what I would love to do is join your company for a week, go through every bit of results from the accounts department, and then better understand how the math all works out. Because when I said earlier on, Steve, that it's a great consumer offering, I meant that almost as kind of a weird diss, because it seems if I was in the UK, I would use it all the time and think that I was getting a deal, and that makes me worry, because in the US, we had a bunch of companies that were offering stuff that seemed inexpensive or seemed cheaper than it should be. And it turns out that companies like Uber were just taking billions of dollars and lighting them on fire. And so like, I had this paranoia about models that appear overly consumer friendly, if that makes sense.
No, it does. But I think when you're giving away, as we've seen competitors, discounts of 30% of their of orders are reportedly using vouchers, right? And you're telling people order £8 worth of daily fresh groceries and we'll practically deliver it for free. Maybe that doesn't make so much sense. Okay, but when you're targeting convenience retail, like I said, to repeat myself a little bit, that has the right average order value, the right gross margins, and you're genuinely investing in that infrastructure, then of course it can be profitable. It can be a very profitable business. And I think on a per order basis, we're already seeing around 2/3 of orders are profitable. So
yes. And so to be clear, that part of the business I understand. It's like that part of the model I get. I'm curious to see how much margin is generated times number of orders, compare that to overall corporate costs. And so like, these are questions not for today, because the company is like a baby.
It's about a year old. Yeah.
So, but these are the questions that I'm going to be looking for as you scale, as you add more infra, as you move to new markets, because I'm curious to see what's replicable, what was that worked early in certain markets that doesn't translate. Because if this does work out globally, I never have to leave my house again. And frankly, huzzah. So like, in a weird sense, as a consumer, I'm rooting for you. But as a business journalist, I'm like, huh. So, but Steve, one last question. We're going from, I've lost it. Teo. He wants to know a generic startup question. So I'm going to leave us with this.
What I say really quickly is, come to London and we'll take you around a dark store and we'll show you the DC, and you can get a feel for what like real long-term thinking infrastructure investment looks like. And maybe maybe that might slightly change your skepticism or your healthy journalistic.
Well, no, I mean, like, in terms of creating a consumer experience, I think having your own infrastructure is the right thing. It's just not cheap, on a capital expenditure basis, and also on a cash flow basis. It's expensive. I mean, again, it's probably the best way to get me what I want as fast as I want it, but it's not cheap. So, but closing this off, because I realized we're actually over time. So sorry, everybody. But one last one from Teo, because I promised. Steve, do you have any tips for young founders, young technical founders? And have you ever dealt with imposter syndrome?
So I think, okay, tips. I mean, that's a long one. So let me deal with imposter syndrome, because that's actually one of my favorite topics.
Sure.
So I think I would have said no until very recently. I've never really suffered from imposter syndrome. I think actually, conversely, one of the advantages of being born with a disability and growing up, using a wheelchair and stuff, is that I've always had that dichotomy of like super low expectations, ironically, apart from my dad, who had the highest expectations ever and would always let me know, versus really no role models. right? So when you grow up in a world of no role or no stereotypical direct role models, you kind of know you're different, or you're perceived as different, and you just have to kind of beat your own, like make your own path, right? So that to me has always meant I haven't had imposter syndrome because I'm not really sure who I'm pretending to be, if that makes sense. So that
Yeah.
said, when I joined Zapp, I mean, our team is amazing, and some of the veterans from industry we've been able to attract, as well as the young talent, hasn't given me an imposter syndrome, but it's like, hey, this is serious stuff.
It's how I feel whenever I meet someone who's like an entire level smarter than me. I'm like, yes, I should probably, just like try to like level up myself a little bit to meet that. But we're overtime, Steve. We got to stop. But a real pleasure, and I'm looking forward to talking to you again in maybe 6 more months when you guys have had a little bit more time in the market. Because again, the company is so brand new. But rapid delivery is fascinating. Good luck competing with everybody, I guess is the only way to say that. And I'll just leave you with this, Steve. We miss you over at TC.
That's really cool. I miss being there. What I will say is, stay for long enough, and you can cover our IPO, right?
I would love nothing more than to harass your CEO and you on IPO day. So if you can pull it off, let's go.
Yeah, many years.
3 years, guys. 3 years tops. They raised 100 million and they're barely a year old. They can go public in 3. Anyways, Peter, back to you.
Thank you so much, Alex and Steve, for this wonderful talk. We'll see each other shortly, I guess, in only 6 months when the company goes public. But in meanwhile, I'm gonna keep ordering from the Zapp, try Zapp. So that's really good. I mean, it's been an honor really to have you on the stage, Steve and Alex, all this time. And I think our audience, our community in London, just loves when we do this together. So very grateful for this always. And then happy Thanksgiving, Alex. I know it's a holiday today,
yes.
so thank you.
I'm off to my in-laws' house right now to eat and then pass out on the couch. But this made me like take a shower and like wash my face. So it's always good to do some camera work because it makes you try a little bit.
Makes you look good, yes, as well. So I just want to mention that our next event is our virtual Christmas party on 14th of December with UK Business Angel Association and Outside Ventures. And then from January, we're going to be doing physical events. So we are back in the game, and then we can't wait to see you all in person. So that's what we are really looking forward to. So for everyone who wants to just stay, please go to the networking tab on the top right screen, and we can kind of have a chat. But until then, guys, once more, thank you so very much for this wonderful talk, and have a happy Thanksgiving.
Thanks. Have a drink for me. Bye, guys.
Thank you. Bye.
Bye.